Hey everyone, welcome back to the Daily Gold Podcast. Today we're speaking with David Morgan. He is the editor and publisher of the Morgan Report. You can find that at themorganreport.com and also silver-investor.com. Dave, thanks for joining us today. How are you?
I'm well, thank you.
Dave, the first thing I want to ask is up until maybe we could say last Friday, even though silver was up for so many days in a row, it had really underperformed this rebound, as you know, that started in December. The juniors, the mining stocks, they've just rallied so strongly. You know, gold has rallied a little bit. Silver was kind of the laggard. So I just want to get your thoughts on that. And I mean, is that significant at all?
I don't think it is. At times silver actually leads gold. I think that can be proven. But regardless, times gold leads silver. This has been one of those times. There's more interest in gold by far. A lot more money goes into gold than silver. But it was a bit of a shock, even to me, I would say, that, I had a dollar move last Friday. Not that silver can't do that. I think it goes to, the point that if anything can move either direction, silver is one of the commodities that can do so. And it was interesting that not only did it go up a dollar, but it closed on the high, which, as you know, being a CMT, is very bullish. So whenever you get a commodity that closes on a high, that portends that the next open is probably going to continue through with some follow through, which we did, even though the market was closed to the U.S. markets on Monday. But even on Tuesday, silver was the only up market yesterday. And then today, of course, we had some kind of, some profit taken, pullback, whatever you want to call it. But no, I wasn't that surprised. I think the main thing is that gold really is kind of leading the way, right now in this intermediate term.
And let's talk about the stocks because both, I mean, the gold stocks have been so much stronger than gold, and the silver stocks have been so much stronger than silver. I mean, how does that factor into your analysis of the market right now?
Well, to me, it indicates, what I've said for a very long time, and that is in a bull market, that the equities will not only outperform, but outperform significantly. So, for example, Vino Silver, which is one of our speculations, that stock was under a dollar for a while. Now it's about 220. So you've got a better than 100% move in a silver stock when silver itself's up 10%. So that's a 10 to 1 factor. Normally in a bull market, you get about a 2 to 3 factor, meaning if you get a 100% move in the metal, you get a 300% move in an underlying equity. That's a top tier equity. But as you said, we've seen, these massive moves, but it's for several reasons. One, the market was so oversold. There was such incredible value in many of these companies, and the market has finally recognized that. So they're going to shoot up, from that way, way oversold condition. And then you've got some that are held with real huge short positions. And so shorts that are smart are going to, cover, and they're going to cover, perhaps even at a loss in some cases, just to make sure that they're out of the position. So there's a lot of factors that go into it, but definitely that's one that I look at and take to heart, that when the equities are showing that kind of strength and start up before the actual rise in the metal itself, that's a strong indicator that the bull market is intact.
So, I mean, kind of a point blank rebuttal here, but I mean, just for the sake of the rest of our conversation, do you believe that we've started a new cyclical bull market for precious metals and the equities?
Absolutely. I'm on record as having called the bottom in silver on the 28th of June, 1817, intraday, on a day that was called a key reversal. Again, as you being a CMT knows what that means. We touched 1817, maybe there are only two contracts traded. And then the shorts started covering like crazy. We closed at 2007 on that same day. We had about a $2 swing in one day, and they call it key reversal for a reason. I said that was it. That was the bottom. And so far, for about 8 months, I've been correct. What I really want to see here is the breakout point of 21, which we've done, maintained for a few more days, and good volume on top of that. But I think we really have seen the bottom of these metals. I know there's many out there, market technicians and others, that think that we're going to see, $1,000 gold or, $14 silver or some, pull some number out of your hat. I don't see that. I think the bottom is in.
Kind of a more difficult question, but Dave, I've looked back and studied how these markets, how a cyclical bull market evolves. I mean, obviously, as you know, the percentage moves off the bottom are so strong, and from what I've studied, it seems like you don't really get like huge pullbacks along the way, at least to begin with. You kind of get minor, small, short, fast type pullbacks. I mean, what is your expectation for how this move is going to continue to develop? Do you think we're going to see a choppy move, or do you think it's just going to be strong and that people are going to have to take advantage of the weakness? I mean, the people that miss the bottom and they've seen this big move, that they're just going to have to take advantage of any weakness they see.
That's the way I see it. They're going to have to take advantage of any weakness. I mean, again, you being a certified market technician, when these gaps are filled, for example, a lot of them have been filled on the equity side. And you might get, that area as being a buy point if you're going long. But it won't remain so for very long. I think you're going to be in a position where silver is going to, work its way back up into, the mid 20s, and gold's going to be over, the 1550 level, and it's not going to be a matter of, months and months and months. I mean, it could take a long time, but I think what's going to happen is this market is going to keep moving up slowly enough where most people that aren't paying attention don't really see it. And people that are kind of on the sidelines are saying, my, isn't that interesting? I didn't know gold was back to, pick a number, 1650. My, I didn't know silver was at $28. Last time I looked, it was at 20. And again, I'm not saying this is happening overnight, but it goes to the point you're asking, and that is this going to take place in a real choppy way? I don't think so. The choppiness is over. If, looking at channel theory, which you do, once you break the channel to the upside, depending on the base that's built, and what the physical commodity underlying it is doing, you can get moves that, again, aren't going to be rocket ships, but they're going to be, 3 days up, 2 days down, 4 days up, 1 day down, 6 days up, 2 days down, that type of move, rather than, what we've been witnessing for the last 7 or 8 months.
Okay, now let's move into more fundamentals, Dave. As you know, I mean, the QE was a reason for that 2008 to 2011 rally, and we did kind of get that reflex rally after the big correction in 2011. Everybody was talking about QE3, how bullish it would be. Initially, it was bullish, and then the QE kept going on, and the stock market was going up, and it turned out we were in a cyclical bear market. So, what do you think? I mean, as far as this year and the recovery that we're seeing, I mean, what do you think the leading fundamental reasons for that are going to be?
Great question, and I just want to reiterate a little bit. I mean, when you go back into 2008, QE2 was announced, and I'd gone long at 19. It was a channel formation, broke out at 19. I went long, and it stalled out around 26, and I got out of position. But I'm very good about letting the market tell me what to do, and not me tell the market what I think it should do. And what happened was QE2 was announced around the $26 level. I got back on it, and it went from 26 to 48. So if you go back and just freeze that snapshot in time, then what that said, at least to me and many, is that silver was, as Professor Jastrom said in Silver, the Restless Metal, there's no better way to protect your assets than silver, much better than gold in an inflationary environment. So everybody at that point in time, again, we're taking a snapshot and we're not looking into the future yet, which we know now, that's the place to be. And it peaked out. I called the top at 48, and from that time, then all the other QEs came. Well, one of the guys that does research for me, he says, "Oh, I'm going to buy these calls. I'm going to do this and that. I'm going long, 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 long." It's even more inflation down the road with QE3's announcement. And I said, wait and see. I've been through this before, and it's going to go the other way. And he didn't believe me, and of course it did. So getting to your question, what is the fundamental fact that's going to drive it higher this year? I think it's going to be a realization that no matter what the powers that be do, that their methodologies of adding debt to a debt-based monetary system, a debt-based problem, isn't going to help. It might temporarily, you might get some recovery here or there. You might be able to shine the light on something and say, look, see, this looks wonderful. We're doing really good over here. But the overall condition of the physical economy is not getting better. and that realization will come back into people that have left the market, and more people that aren't in the market will come to that realization. And I think it's going to be, fairly methodical. In other words, it's not going to be an overnight phenomena unless some big event happens, which I don't, rule out, but I doubt will take place. So you see more people coming in the market on that fundamental basis. It's just simple. This fiat money system cannot go on forever. Things that can't go on forever don't. And there are corrections that the market by itself can do that actually overpowers the bankers themselves. It has taken place in the past, and it will take place again.
Yeah, I really like the first part of your answer there because I think it was Paul Tudor Jones who said, figure out what the market is doing, but less so why it's doing that. So yeah, I definitely appreciate that answer. We can't always, I mean, as you said, something that can be bullish one year is not necessarily going to be bullish the next year. Now, getting into more fundamental factors, let's talk about GLD and SLV because, of course, we've seen a huge amount of gold come out of the GLD, but we haven't seen that with the SLV. Any reason for that?
This is pure speculation on my part, so let me repeat that or bear that in mind. GLD, I think I've always thought up until the last year or maybe slightly more than that, that silver would be the place that would see the most demand physically that would start cracks in the system, meaning that the physical market would finally take on this paper paradigm. But I've changed my opinion on that as of probably better than a year ago, that gold seems to be the place because one of the reasons I think that the GLD has been drained is because it has physical gold and it's needed to satisfy people that won't keep their mouth shut and say, I don't want a contract. I don't want this gold certificate. I don't want this bank statement. I want the real gold. And I think more and more nation states, large banks, private individuals, hedge funds, you name it, are demanding the physical, tangible asset. And for that to take place, they got to go find it somewhere. And the GLD is an easy place to go find it. So I think that is what's drained a lot of the GLD away from the gold from the GLD out. On the silver side, there doesn't seem to be that much demand for physical. And there's a lot of reasons, and I'm not going to try to make an excuse. I believe this is true, and you don't have to agree. Silver is bulky relative to gold. It's not bulky relative to another commodity. I mean, you can put a great deal of silver in the space of, a contract of soybeans, for example, and have a lot of space left over. But relative to gold, it takes up more than 60 times the volume. Gold is denser than silver, so it's maybe, I don't know what it is, 70 times greater volume. So for some hedge fund or private individual or large whatever to take physical possession of silver is a bit of a problem. They're better off leaving it in a COMEX warehouse, which is really a bank, as you know, to store their metal. So there isn't quite the demand on the physical side of silver because there isn't like the storage space or the preparations that are necessary to hold silver in large physical quantities. Whereas gold, I mean, you could open up a desk drawer in an office somewhere and fill that full of gold, and you're talking a lot of money. Whereas with silver, you're really not talking that much. So I think that's part of the reason. But I don't care which one breaks it first, if it's silver or gold. But when the physical market starts to take control over the paper paradigm, I think that's when you're going to see things move even stronger.
Okay, so just to follow up to that, I mean, when do you think that's going to happen? Because not that I'm skeptical about that, but I remember, during the 2008 bear market and during this recent bear market, we had tons of people howling about the physical demand, the physical market, yet the stocks were getting slaughtered and metals prices were coming down. So how can you tell when, I mean, is there a way as a technician or someone who follows the market? I mean, is there a way where you can tell when the physical market is really going to override or overcome the paper markets?
Yes, there is, and it's the real deal. And I'm going to get some of my peers upset, but I don't care. I'm not here to make friends. I'm here to tell the truth. And that's when you get into backwardation. That's real backwardation. I'm not talking about this interest rate spread that you hear about on Zero Hedge, which I like, but a lot of these guys are talking, they're basically, it's an interest rate backwardation. It's not true backwardation. When you see real backwardation on the futures exchange where it's significant and it goes on day after day after day, I'm not talking like a 3 day in a row. I'm talking about like 3 weeks in a row or 2 weeks in a row. When you see that, then you know that the physical market is taking control. And that's about the only way to know. Now, whether or not that will actually occur, it's hard to say because the rules of the exchange are such that if the CME decided that, oh my goodness, look at what's happening, we need to fill in the blank and step in and take control, we're going to only settle for cash, or we're going to delay, or we're going to have to lease it back. And let me go to a quick example. When the palladium market went from roughly the $200-300 range up to $1,100, that was done on one physical demand. That was called Ford Motor Company. And when Ford Motor Company wanted physical palladium to put in their catalytic converter line, what took place was at the top of the market, you had to put up twice the amount of the cash market to hold a futures position. Now, this is absolutely preposterous, but that's exactly what they did. And on top of that, the London market made the people that own the physical palladium lease it back. So there's these situations that unless you're a metals head like me, you really don't know that took place. And people say, well, that sounds like science fiction or you're making it up. No, check it out. That is what took place. So what I'm suggesting is that we could have a squeeze on the market that is real, and nonetheless, let's say the power structure that exists could make it look, let's say, more benign than it really exists. And of course, this whole thing of palladium, as an example, real fact, you could go back and check, really didn't last that long, And so to say that, well, David, once the physical market takes over, it's the end of the paper markets forever and on and on. I'm not saying that. I don't know what will happen in the future. What I am saying, if you want to know when it takes place, look at backwardation, look at it for more than 3 days, and see what the market makers do to get a real handle on it.
All right. Well, excellent answer, and I thank you for your expertise on that because there's a lot of fluff type of analysis out there about what's happening or what's supposed to happen. Now, shifting gears, let's talk about Mexico because, as you know, there's a lot of silver companies, silver explorers, silver producers with projects in Mexico. There was that recent news of the new royalty tax. What do you make of that? How much of a negative impact is that going to have, if any?
Well, it has some. And we did I have 3 levels of service. I have your basic service that gets the reports and most of the updates. And I have a service that's that plus I do videos on what I see in the marketplace using technical work and a lot of videos that we shoot at different conferences and that type of thing. And then I have this mastermind series, which is the top level, usually fund managers or high net worth individuals. We had one of the silver producers in Mexico. That's all they do is produce in Mexico. And we asked them that question point blank. That was last month's whole take on the mastermind series. And I tend to agree with him. Basically, it has an impact, but for a large producer, it's livable. And what I didn't know, and he taught us, was it's pretty much in line with what you're going to pay in other jurisdictions such as Chile or Peru, which are 2 areas that produce a great deal of silver as well. So it's not something anybody likes, but it's something that's livable in that case. Now, we're still doing some work on what if scenarios, meaning if you are a junior in Mexico and you're exploring and your break even point under the old tax law was like 3 years out, and now with metal prices, and you have to assume with sensitivity analysis, as you know, what the future price will be and what the net present value of money is and all this stuff, and it's not really that complicated. It's a formula for it. If that company wouldn't break even for 7 years or so, then is it worth doing the project? So the point I'm making is that if you are a top tier or mid-tier company and producing now in Mexico, it has an effect, but you're probably going to be able to still make a profit and do okay to well for your shareholders, especially if you believe what I believe, that the price of silver is going up. But if you are on a low end, you may never get a project off the ground now.
Okay, and Dave, finally, for all the newbies out there who are listening, I'm thinking of a person who, maybe they missed the first couple runs in precious metals. They've made a lot of money or decent money in the last several years with conventional investments. They're seeing the value in precious metals. They're seeing a new bull market forming. Uh, Thinking of those people, I know it's kind of a simple question, but if you have $10,000 to invest today, how would you put that to work in precious metals?
I think I'd divide it up. I would do, depending on your age and risk tolerance, I'd probably do physical, like I always have taught, and the rest into mining equities. And if it was that amount, I would just find a good gold fund like Tocqueville or Frank's. One, I can't think of his last name. He speaks at every conference I go
Holmes.
to. Oh, Frank Holmes, thank you. And, just do that. To try and individually pick what that amount of money isn't worth it, in my view. I think it better just use a Frank Holmes or Tocqueville or, Hathaway's fund or whatever. So I think that's a good way to do. By the way, before we close out, if you look at IBD or any of these sectors, the strongest sector so far in 2014 are the mining equities. So, it's beating the S&P, beating transportation or, cyclicals or energies or whatever. There's all these classifications, as you well know, but the one that's leading the pack right now are the gold mining mutual funds.
Well, thinking about that, Dave, just another question, if I can. It seems like why do we always get bottoms in December?
Well, it hasn't been that way forever. I mean, I'm much older than you, as you know, and we used to be a cyclical part of the precious metals markets that they'd actually start up in December and follow through the January, February, March. I mean, you got to remember the 1970s bull market ended January 21st, 1980, and it has started up way into December. It's only been the last few years, and I used to have almost every year memorized. I don't anymore, forgiving me, it's my age, but the last 3 years, 2012 and 11, both those years closed off on the low, I think, at the last trading day of the year. And the reason for that, in my view, is not the cyclicals that didn't work, was that there are so few traders left. It's really easy to push a market around that's small, and it's very easy to push a market around that's small with very few participants. And as we get closer and closer to the holiday season, there's less and less participation in those markets, so it's pretty easy to push it down. That's what we saw in 2011 and 12, and pretty much in 2013, although this year, or last year rather, started to come up somewhat, as you indicated during the show. And then, of course, we've seen some pretty good follow through so far in 2014.
Okay, Dave, before we close, could you tell our listeners about the work you do at the Morgan Report and how they can subscribe?
You bet. The easiest thing to do for the free stuff is get on our YouTube channel, which is Silver Guru, or go to Twitter, which is at Silver Guru 22. We have a free e-letter that goes out every Saturday, and that's just go to the website and pull down on the left-hand menu. It says join free e-letter. It's a double opt-in, so you're not going to be able to send it to your friends. You'll have to acknowledge it's you. And then if you're a serious investor, we have 3 levels of service, as I mentioned. That's all on the right-hand side of the website. We have 3 videos that explain it all.
Okay, Dave, thanks so much for your time today and your great analysis. As always, I and my listeners really appreciate it.
My pleasure. Thank you.